Thank you guys for being here. We're just going to wait another minute or so before we begin. Thank you, Toby, for being with us again. For those of you who don't know me, I'm Thea. I'm the community manager at the Project Finance Institute. I take care of everything, events, community activity-wise, platform questions. If you have any, you are welcome to reach out to me anytime via direct message or share your experiences and questions on the PFI platform itself. I will let Toby introduce himself too. Enjoy the session. Thanks, Toby, for being with us.
Brilliant. Thanks ever so much, Tia. So a very warm welcome to everyone. Just a little bit of an introduction to myself. We're going to spend an hour looking at the three financial statements, a review of the basics of what they are, how they're pulled together, and actually go into perhaps just a little bit more detail, in particular for an area which is not necessarily really covered on courses, but the application of direct and indirect cash flows. So we will explore that and show it through some very simple modeling. So as you can see from this slide, my name is Toby Tucker. As you can see, I've had quite a tough paper round. I am actually only in my mid-30s, but I'm actually a chartered accountant, 25 years of banking and corporate finance experience working on all sorts of transactions from schools, hospitals, roads, shipping. And I've been teaching financial modeling for the last 10 years. And one of the main instructors at the Project Finance Institute. My main role is, my day job is working for an organisation called Scottish Futures Trust, which is a Scottish government agency. And really my responsibilities are trying to take what is government policy, and in particularly in the net zero space, and trying to create commercial, legal, financial, technical frameworks, converting that policy objective into deliverable projects on the ground. And from the slide, you can see my focus is on making our buildings in Scotland net zero through energy efficiency and providing net zero heat supplies. So that involves anything from looking at district heating, the wind farms, all sorts. So that's a little bit of background about myself. So we have an hour together, and what I want to do is talk about the three financial statements, because they are the absolute cornerstone of our key outputs whenever we're producing a financial model. Now, for some of you, this may actually be a review session. For some of you who are new to financial modeling, new to accounts and looking at them, this could all be hopefully quite insightful as to what they are and how they are pulled together. So, the three financial statements, what are they? Well, we've got three of them. We have the income statement, cash flow, and the balance sheet. I think the easiest one to understand is the cash flow, because what that does, it records just the cash only transactions of the business. So it's quite straightforward. Cash coming in from sales, and we've got cash going out from, to suppliers, covering costs of goods, interest payments, all sorts. So cash, that's straightforward. The income statement is a little bit more complicated because it records both cash and non-cash transactions of a business. What's an easy way of thinking of this? I always think of the income statement as really the place where we book our transactions. So when we record an event or transaction happening, we always record it in the income statement. The timing of that could well be very different from the actual cash received. So we might record a sale But if we're offering credit, we're not going to necessarily receive the cash until a little while later. So that's sort of main distinction between the income statement and cash flow. The balance sheet records what we'll say the assets and liabilities of the business. For us, I always think about, we all have our own personal balance sheets. I've got a property I own. Let's say it's worth $1 million, but £400,000 mortgage. So assets less liabilities, I've got net value of 600,000. If only that were the case. But from a modeling perspective, what the balance sheet does is really record and tracks the difference between things which are going through or flows through our income statement and element or the corresponding components which are going through our cash flow. Now, I'm not sure how many of you out there are accountants, but for me, when I trained as an accountant, the balance sheet would have to go out and we'd audit and check for a particular company. We'd check the bank statements, we'd check their debtors and creditors ledgers. We'd have an inventory of all their assets, and we used to verify everything on the balance sheet in terms of assets and liabilities. When it comes to modeling, it's almost like the balance sheet. It's almost like a memorandum account for us. We can actually model using a standard structure what our balance sheet item will be, which is really handy because we'll come on to it in a moment, is just we use a very, very standard structure. So that's just a brief overview: income statement, cash flow, and balance sheet. What I will come on to is now is having a look at the cash flow. And just to summarize, really the cash flow financial statement is split into three broad components. We've got an example here. We have cash flow from operating activities, and this is really only looking at all of the revenue producing activities. So revenues coming in, operating costs getting covered. And what I want to look at in more detail as we go through this webinar is a bit more understanding of the difference between the use of the direct and indirect methods. We have two other components. We have investing activities. So that's the buying and selling of non-current assets. So this is buying sort of the main equipment or kit, which is generating our cash flows. So wind turbine, generating electricity, that would be the non-current asset. And alongside that is the other element in the cash flow of the financing activities. So in essence, these are the things which are used to support the purchase of those non-current assets. So it could be long-term debt, share capital, and equity. So we will come back to this in a little bit more detail. So what I'm going to do now is just go across to a very, very simple model I have pulled together. I'll upload this start model to the webinar forum, or you'll be able to access it. It's really, really simple. We've got the three financial statements here: income statement, cash flow payment cascade, and balance sheet. And this next session, or few minutes, I just want to show you how we actually connect them all. Just a little bit more on this model. If you do one of our courses, this will be very familiar to you. It's follows use of something called the FAST standard, standard set of sort of rules and design principles for building financial models, but this model is so simple. Got a very basic input sheet, a time sheet, very important for creating our dates, time rulers, flags, for undertaking a modeling. I've got a sheet here on senior debt, and here summary financial statements, which would be our key outputs. And finally, a temp sheet. This little sheet contains core templates we use all the time in our financial modeling, and we will come back to use of this particular template in a moment. So we've got some very brief financial statements here. Income statement, revenue, operating costs, accounting depreciation, senior debt, interest expense, tax expense, and we get net income. We've got a cash flow statement here, very similar components, and then finally a balance sheet. At the moment, you can see all of these are unlinked. And what I'm about to describe to you is one of the key things we undertake, particularly if you're building a model from scratch, for being able to link all of these components. So what I'm going to do is create a little scenario. Let's pretend I'm selling secondhand laptops, and I'm selling them to one of my friends, and I'm selling for sort of $100, pounds, euros each. And I've got that over 3 periods. So these sales, I'm going to assume that as I make the sale for this particular period, here you can see we've got a monthly timeline. I'm going to receive cash for those payments. And I'm just going to go through this stepwise. So here we have revenue of 100. I've got a corresponding line here. Don't know what it's called EBITDA, earnings before interest, tax, depreciation, and amortization. Assuming nothing else is happening for time being, we've got no operating costs, no depreciation, etc. I can overwrite and say my EBITDA for this period is 100. Got no accounting depreciation, no senior debt interest expense, so I'm going to get to a profit before tax figure of 100. Luckily, let's assume for time being, we're in a jurisdiction where we've got no tax. Absolutely fantastic. I end up with net income of 100. So for that month, I've generated 100 of income. Okay, I will ask someone. So when we get to the end of that month, I've generated this income of 100. I need to store it somewhere. And that storage place ends up being our balance sheet. So I'm going to come down to the balance sheet, and I'm just going to see where, if you want to type in the chat, where would that 100 of net income get stored at the end of that period? It will actually come and feature on my balance sheet. Where will it go to? Let's see. People are putting stuff in the chat. No, Fatima, not accounts receivable. Oh, asset. No. Oh, brilliant. Retained earnings. It's all coming through now. Brilliant. Camilo, you're saying cash. We'll come back to that. It's retained earnings. Perfect. Everyone's flying through that answer. Absolutely. So what I've got here is retained earnings of 100. Now let's have a look at the other side. Remember, we've got this transaction of 100. What would happen now? I said this is a cash transaction basis, so I'm selling it to my friend. I've booked 100 in my accounts. I am going to get cash of 100. If we follow exactly the same logic through, I've got operating cash flow of 100. I'm going to have pre-tax financing cash flow of 100. I've got cash flow available for debt service of 100, oh, not 1,000. This is all flowing through. So I get a net cash flow at the end of that period of 100. The next $1 million question: where does this cash at the end of that period, where does that go to on my cash flow? Let's open that up to the chat box. Trying to see. This one should be a lot easier for everyone. Retain cash balance. Perfect. Everyone's got that. So yeah, that's going to go to retain cash. This has now completed what we would call our double entry for accountants. We've generated cash of 100, which is great. We love having cash in the bank. And the other side of the entry is we've created a liability of retained earnings of 100. Why is that a liability? Well, the reason it's a liability is because it is owed to the shareholders. People will invest in the project, and in exchange for them putting in equity, they will get access to retained earnings. So all I'm going to do now is very quickly say, well, if I was to follow this logic through for the next 3 months, so that's, let's assume I'm getting net income each period of 100. Correspondingly, again, cash receipts, or I should put these in there. I'm getting pre-tax, pre-financing cash flows of 100. That's all flowing through for each period. So this is all good. The next question for all of you is, for this period here, 1 month on, what's my retained cash and retained earnings balance going to be? So again, put your answers in the chat. 200, brilliant. Superb. So this is going to go up to 200. This is going to go up to 200. And likewise, in the following period, this is going to go up to 300. So I've gone through this stepwise. I know it's quite simplistic, but it's just to give us an idea, understanding how the income statement, the cash flow statement, and the balance sheet are connected. Now, what I am going to do is show, if I now put these, instead of me doing this randomly, I put these in here and press return. I do a recalc of a model, F9. I get 100 flowing through, so now my calculations are all working and they're flowing through the respective cash flow and income statements. Although that one seems to have, what have I done there? Oh, for some reason that hasn't updated. That's slightly unusual. Just copy that across. That all flows through, but my balance sheet doesn't have those balances of 100, 200, 300. So this is where we are now going to connect all three financial statements together. And what we use is this structure here in all our models. this structure on the temp sheet, we call it a corkscrew. And you can see from the formula here, we've got bracket, triple X. It's a generic structure. We just need to overwrite those labels. And we have a structure here, which if I look at the formula, it says take beginning balance, add whatever's going to make that balance increase, take away whatever's going to make that balance decrease, and that will give me a closing balance. And this structure is what we're going to use to connect together and have now create an set of integrated financial statements. So I'm going to take a copy of this. I'm going to come to the bottom here, and I'm going to create two copies here, because one, I'm going to use this structure to create a retained earnings balance, and the other one I'm going to use for a retained cash balance. I'm going to do a search and replace, Control H. Let's have a look at this. I want to look for my open bracket, triple X, close bracket, and replace it with retained earnings. Replace all, superb. I've got a structure in place there for calculating what my balance sheet item is going to be. And likewise, I'm just going to do exactly the same for my retained cash. This time, instead of retained earnings, I want retained cash. And what is lovely when it comes to, financial modeling is all that we're trying to say is all we have to think about in terms of balance sheet items is what's going to make our balance go up and what's going to make our balance go down. So first of all, I am going to actually get some real revenues in here. Let's just break these. I'm going to let this equal 100, and I'm just going to let this equal the previous period. Got a lovely growing business. I'm going to let it grow by 2% each month, just to copy that across. So that is good. I'm just going to update the calculations. So yeah, we can see our revenues gradually increasing through that. And I know at the moment, my revenue, which I've calculated here, this is also flowing through my cash flow. So I'm just going to have this, create a link to this because they're the same at the moment, because I said we're modeling on a cash receipts basis. So when it comes to thinking about our retained earnings balance and retained cash balance, so I'm linking the income statement and cash flow. For my retained earnings, what I need to do is just think about what is going to make my balance increase over time. And we can think about what will make it decrease over time. Well, we previously had a look and said, well, what's going to make my retained earnings increase is going to be my net income for that period. Remember, we said we get to this point, it's the end of a month, where do we store all of that profit we've earned? Well, it goes to retained earnings on the balance sheet. And so what happens is this item here, I'm going to create a link to it in my retained earnings corkscrew structure. And what we see here is now a retained earnings balance which increases in time. So what we see here, I'm just throwing up some trace arrows, is that we see this winding forward in time of we start off, we generate 100 in this period. That increases our balance at the end. We're familiar with that. That is linked to the next period, forms the opening balance of the next period. We generate net income there of 102. So our formula here says we're going to add whatever's going to make it increase, take away whatever's going to make it decrease, and that gives us our closing balance. Brilliant. We've got exactly the same sort of component for our retained cash. Instead of our net income making it increase, what we said is that we are going to have our net cash flow. So I'm going to take a copy of that and I'm going to create a link to this net cash flow here in my retained cash flow. Fabulous. So there and if I update my model, we can see the balance increasing over time. So now I've calculated this, I can now use these in my financial statements. So for my assets, this is going to be linked to my retained cash balance. Copy that across. And if I update the model, we can see total assets there. Fabulous, we like that, building up in over time. But this isn't matched by corresponding liability. We need our retained earnings. So that's where I now need to create my second link here. This equals our retained earnings closing balance. Double tap and create a link for that. And voila, there I now have my 3 financial statements integrated. So hopefully you can see that's all fairly straightforward. And this is what I do on every single model I build from scratch. Most of the time I'm using, a model. I don't want to go through this all the time, but I'm hoping for those who particularly who were unfamiliar with financial statements, this bit is just to show you the different financial statements and actually how we integrate them very easily into a coherent set of 3 financial statements. And the beauty of using this corkscrew structure here, it's a standard structure. Whenever you're undertaking financial modeling and using our approach, Jinx balance sheet item, all I need to do is use a corkscrew. This standard structure, which we have as an element on our temp sheet. So the only other thing we should think about is actually what will make our balance go down. And we're not going to model it, but it's important to think about this is said, well, the one thing I did mention is these earnings are a liability. They are earnings which are owed to our equity investor. And ultimately, these will be paid out to our investor as dividends. So as we build up cash and we build up earnings, we're going to try and compare available earnings with available cash, and whichever is the lower, we're going to be able to pay that out as a dividend to our equity investors. So what I would just put in here as a label is that these are dividends. And if I assume they're declared and paid, it's a common component which would feeds into both our income statement and our cash flow. We're not going to model that in this session, but is something which you would need to model in due course to get all this lovely cash and paid out to investors, and that will correspondingly reduce your earnings. So if I was to look at this particular period, what I would like to do is say, well, I've got cash there of 100, I've got earnings of 100. So what I would like to do is pay out a dividend of 100. And what you'd see is if I update my model, that uses up my cash and my earnings. So you end up doing one of our courses, you see specifically how to model that particular component. And then that leads you on to looking at equity returns and all that good stuff, which is really important. Okay. That's us looking at how we integrate our three financial statements. We've modeled this based on a cash received basis. I am going to go back to my presentation, and we're going to have a little bit of a closer look at the cash flow statement, because the reality is, in fact, I'll come back and let's have a think about this. We know some of the things which go through our cash flow aren't going to be mirrored necessarily in the income statement. So let's have a look at our revenue. Let's say now, instead of my mate, him giving me cash, I know he's a good guy. I'm going to give him a little bit of credit. So he only has to pay me 50 of cash up front, and he can pay me the rest in the following period. If I look through now and I overwrite this, the cash actually received, I overwrite it and just say that's 50. This is going to flow all the way down, give me a net cash flow of 50. That will give me retained cash of 50. And so again, in the chat, you tell me, where will my balance sheet is not balancing now, my liabilities don't match my assets. Where's the balancing 50 going to go? Let's just see if receivables, perfect. Right, absolutely. So brilliant. This is now not non-current asset accounts receivables. So I'm going to have 50 there. If I update that, perfect. Everything is balancing. So that's good. I just now need to go back, make sure I correct this, update my model. Superb. Now, the reason I mention that is when it comes to the cash flow, there are two ways of looking at cash flow. And I said there are three components: operating, investing, and financing activities. For the operating activities, there are two approaches you can use. There's one called the direct method and another called the indirect method. And that's what I want the remainder of this session to show you how they work. So the direct method, in some ways, is nice and straightforward in that it looks at the actual, tells us the real amounts of cash which come into and out of the business. So if we're using a direct cash basis, we will see in the cash flow revenues, those amounts each period represent the actual cash received by the business in that period. Likewise, operating costs, it's the actual cash paid to a supplier during the period. That's got lots of advantages. Particularly, it's really simple to understand, because when you look at the line, you say that's how much the cash in and out of the business is for each period. For lots of you, obviously members and, thinking about joining the Project Finance Institute, that's the approach we see in all of our project finance models. Because when we're, presenting cash flows, etc., to financiers and banks, that's what they generally want to see. So we tend to find it in project finance models, the direct method, and also if you've got really small businesses with very few transactions, you also see it there. The indirect cash flow is slightly different. What we do is actually start with what is our net income from the income statement, and then we have to make adjustments to work out what changes there are which impact the cash flow. And so it's got a lot of advantages. So my wife, she runs her own accountancy practice, lots of SME businesses. It's really easy to be able to calculate an indirect cash flow basis. Reason it's good, if you look at lots of financial statements of companies, they will have the income statement, they'll have the balance sheet. Remember I was saying about on the days in audit, that's all nailed down and substantively audited. So what they can do is say, well, take the income statement and we can look at movements between the balance sheet balances, and that will allow us to work out what the cash flow is for a particular period. So it's really easy to calculate from companies' ledger record, their records, and their accounts. It's quite easy to prepare with minimal effort, and we are going to do that now. So what I want to do is show you how we could calculate the cash flows for this little model we've got on an indirect cash flow basis as well as a direct one. I've got some other slides which I will circulate and make available to you. I'll just go over these very briefly. Just got some examples of direct versus indirect method. Here, like the indirect, talk about using net income, so income statement value. Then we have to look for changes in accounts payable or liability to give us a net cash flow balance. The direct method, which we'll also look at, is a little bit more complicated, but you're looking at the actual cash received. There's a comparison here of a couple of financial statements. This is quite straightforward. We've got 3 million of revenues. We've got some less cash paid for cost of goods sold, and that gives us a net cash flow of 2084. Here, it's a little bit less transparent on what our cash received from revenue is. We start with a net income statement, a net income of 4.7 million compared to 3. You think, that's not that good. We get to the same number of just over 2 million, but we have to do it via these set of adjustments. So again, don't worry about all this. These slides will be made available to you. I just want to show you, actually from a modeling perspective, how you can do both direct and indirect approaches. I've also included a couple of slides. It's probably a little bit tricky for you to see, but if you're trying to create a direct cash flow, here are the steps you need to undertake in thinking about pulling together that type of cash flow statement. And likewise, what you need to do if you're producing an indirect cash flow. At the end of the day, they're going to give us the same net figure at the end of a particular period. So you've got all of this guidance, which will be uploaded. Great. So at the moment, I've got cash flow payment cascade here, direct method. What I will do is I'm going to insert some rows. And what I might do here is put a title, cash flow. I'm going to put indirect method. And what I'm going to do is assume, first of all, we need to start with nothing from our cash flow here. We start with our net income from our income statement. So I'm going to take that or create a link to it. And then what I'm going to do is undertake, I'm going to put a line here, movement in accounts receivable. Mark that as yellow at the moment, and then this is going to give me a net cash flow here. Just put some borders around that, and that's going to be the addition of each of these and some units. So just to recap here, the indirect method, what I'm doing is starting with a line, net income from my income statement. And then what I need to do is work out what my movement in accounts receivable are. So what we're going to do for this scenario is, let's assume we have 15 debtor days. So what does that mean? Well, for this period, it's going to take me 15 days to collect revenue. So if I look back from the end of this period, if this is accrued or revenues incurred equally throughout the month, I'll only collect, or there'll be 15 out of the 31 days here, or 15 over 31, that proportion of this 100 won't be collected at the end of that month. It will be the following month. So what I need to do is say, well, actually, what is my outstanding debtor balance at the end of a particular month? So I'm going to include here, just put accounts receivable balance, and I'm going to have some debtor days, but I'm just going to assume this is 15, and I need to work out what the number of days in a particular period are. So here it's on a monthly basis, that's quite straightforward. And I've actually handily got that prepared earlier. So I'm going to create a link to this. Just get that into number format. And what I am going to do is be able to work out my revenue up here. I can work out what my outstanding, I'll put here outstanding accounts receivable. And this is simply going to equal my debtor days divided by the number of days in the period and multiplied by whatever revenue I'm generating in the period. So we can see that gradually changing. So now what I'm going to do is say, well, what's my, so here in this first month, we're saying, you know, of that 100, I'm going to have 48 pounds of that is going to be outstanding. And what we do, so this is quite an easy calculation, but what I need to think about is what is my movement in accounts receivable balance, and whether it's a positive impact on my cash flow or a negative impact. So if I take a copy of this, bring this down, I take a copy of this label. You tell me if my debtor balance for a particular period increases over time, is that a positive or a negative impact? Is it income coming into the business, or is it income going out of the business? Somewhat. Let's see if you put that into the chat. Brilliant. Negative cash flow. Absolutely. So what I'm going to do here is just say, well, here, this is going to equal whatever my previous period outstanding balance is, less my current period. So if I copy that across, I can see my movement in accounts receivable is an outflow. So now what I'm going to do is take this and drop it into here. Update my model. And I can see now I can get an idea of my net cash flow for that period is 52. So that's okay, because we know outstanding accounts receivable at the end of the period is going to be 48. So if I made sales of 100, it's going to be 48 outstanding. So the net cash flow collected for that period is going to be 52. So hopefully that's quite straightforward. And what we've done here is just created this is using the indirect method. We've taken an income statement, our net income from the income statement, and we've adjusted for a movement in our accounts receivable or working capital balance, and that's giving us a net cash flow of 52. What I want to do now is, for my direct, here I want to have a calculation of what the actual cash is during this period. So it should be, as we know here, it should be, for this particular period, should be 52. I'm hoping when you look at this, the calculation of net cash flow here using the indirect method, it is quite straightforward. One of the challenges, particularly as you get into more complicated models, is using the direct method can be a little bit more challenging. But for this simple case, I'm going to show you how we can approach that for the direct method. So to do that, I'm just going to draw a little graph here, or chart. This is a particular month or period. So we're starting at period 0. This is the end of period 1 or month 1. This is the end of period 2 or month 2. Now, this first month, I know I'm generating revenue for period 1 of R1. In this second period, I'm generating revenue of R2. But I do know that for a particular, said at the end of this month, we generate this revenue R1, that's what we book to the income statement, but we don't collect all of it. We've got an outstanding accounts receivable balance here, where this amount of cash is not collected. So we know AR1 is equal to, we said we've got 15 debtor days, just put divided by 31, and that's going to be multiplied by our revenue. Likewise, in the second period, we've got another corresponding balance, accounts receivable 2. Again, this is 15 divided by 31 multiplied by revenue 2. And this is a bit which could seem a little bit challenging, but it's quite straightforward. Is we know that this accounts receivable balance 1, that will be collected in period 2. It's outstanding at the end of period 1, but it will be collected. And we know that accounts receivable in the second period, that's outstanding. So what we want to calculate is, if I just switch my pen to blue, just want to change a different color. Yeah, let's go for this blue here. So I know in the second period, my cash flow for period 2, I'm going to collect all of AR1. I'm going to have some of R2, and I'm going to be, won't collect all of AR2. So I'm going to put a little formula here to say CF2, using simple vector maths. If I start at this point, it's going to be AR1 plus R2, all of the revenue of period 2, less AR2. That is the key formula. And again, don't worry, this OneNote I will convert to a PDF, and I will put alongside the model and the webinar sort of recording. So this is what I need to do for the direct method. So it's just a little bit more complicated. Now, again, I'm just going to create a little bit of space here. So when I'm thinking about this, normally we say, particularly if you're using the direct method, we'll say in our financial models, whenever you're modeling a balance sheet item, always use this traditional corkscrew structure. So I'm going to take a copy of this because it's a balance sheet item, and I'm going to use this. I'm going to put it as accounts receivable. Is that right? Yeah, it's okay. No, put in a K there as opposed to an L. That's not good. Let me just quickly change that. Just going to clear out. Oh, we're trying to speed through and not be careful on my typing. So I've got the accounts receivable balance beginning, accounts receivable balance ending. So again, when we're thinking about questions, what's going to make my accounts receivable balance go up? Well, it is going to be whatever revenues I'm generating. So for this, I go up to my income statement. What's going to make my accounts receivable balance go up is going to be my revenues. Perfect. So I have that in, update that, I've got an increasing balance. What's going to make my accounts receivable balance decrease is going to be cash received from debtors. So I put some brackets. So this is what I need to model. So what I said is, so I'm going to put here cash received in period. If I look to my formula, said, well, cash received in period 2 is going to be whatever my beginning balance is, accounts receivable balance at the beginning of a period, plus the revenue generated in the period, and take away whatever my projected end of period accounts receivable balance is. So that's what I'm going to do. So at the beginning of, say, this period, my accounts receivable balance at the moment, I've got it as 100. So I'm going to take a copy of that. What I need to do is then add my revenue for this particular period. So I have that here. I should just put a link to that. And what I need to do is take away whatever my projected accounts receivable balance is at the end of period, which is, I've calculated that here in this line, line 51, from what we did earlier. So I'm just going to, oh, I've done that wrong. Let's just relink that, accounts receivable balance. There we go, copy that across. And now I can work out my cash received in period with my units. This is equal to my beginning accounts receivable balance plus any revenue I received in the period, less whatever balance is outstanding. I pop that in there, copy that across, and what I'll do now is take that cash received in period, that I'm going to link into my corkscrew. When I update the model, where we have my cash accounts receivable balance at the end of 48, I've got my cash received now in period of 52. So we can see that here, that's matching. And so my cash received in period, this is now my direct cash flow I've calculated. So if I go to my direct cash flow statement here, I'm overwriting this formula now with the actual cash received in the period. So when I'm comparing my financial statements, here we have our revenue, what I booked to the income statement. Here's the actual cash received in the period. So I can look at those and compare them. Just put a row total there for time being. There's got to be the unwinding of working capital. We won't worry about that at the moment. But what is interesting is now I get my net cash flow at the end of 52.99, and I can see that my indirect method matches with the net cash flow from my direct method. So that is, if I go back to here, we've just used two approaches here, using a direct and indirect, to calculate what our net cash flow is. And the only remaining thing it would need me to do is now, remember, we've got our linked financial statements. If I go to my cash flow, and that will take me, I'm going to overrun slightly and see these are out of balance now, my balance sheet, because my retained cash is lower because I've got an accounts receivable balance. I now just need to take a copy of this and create a link to it on my balance sheet. Drop that in, recalculate my model, and voila, everything balances. So that is us now at 6 p.m. UK time. Going to draw this session to a close. That was hopefully useful, a brief canter through the three financial statements, how they are integrated and linked together, and then just wanting to give you an overview of two approaches which are used for looking at or generating your cash flow statement. You can use the direct method, which is what I prefer in the main, or the indirect method, which is simpler to use, but isn't necessarily straightforward to get the information out in terms of, what cash am I getting in from my customers versus, what am I paying out? That's a very brief overview. I'm happy to take questions if you want to put them on the chat, but otherwise I think we will stop the recording. We'll upload this onto a platform with the models, the presentation, and all it's left for me to say is thank you very much for joining me this afternoon, and hope to speak to you all again soon. So I'm just going to stop. Thanks, Tia. Do you want to stop the recording? Brilliant.
Yes, go ahead and do that. Thanks everybody for joining. Thank you, Toby, for your time. Recording will be available very, very soon. And yes, have a nice evening, morning, day, wherever you guys are based. See you later. Bye-bye.
Take care. Bye-bye, everyone.
Bye.